from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, Apple announces a rare sales promotion for the iPhone in China. But is the discount a bad sign? We'll discuss. Plus, on the latest episode of Keeping Up with TikTok, Meta introduces a new revenue-sharing feature to help creators make more money from videos set to music. What it all means for Facebook's and Instagram's efforts to outrun TikTok. And the flight of tech workers may well be leaving a hole in San Francisco. Can the city recover, or does Silicon Valley need to start reinventing itself as a tech hub? We'll talk about that later this hour. All of that in a moment, but first I want to get a look at the markets and stocks whipsawing with tech dropping lower ahead of what could be a brutal week for earnings. Our Ed Ludlow here with the biggest moves to start the week, and one of those is Walmart. Yeah, we're bracing. So much going on. Earnings season hitting us in the face. Look at the NASDAQ 100 down 0.5 percentage point. Second straight day of declines following on from a negative end to the week. The Philadelphia Semiconductor Index, or SOX, also lower by 0.6%. Tech, the real underperformer, even with Biden and the administration giving some fighting talk in a virtual meeting with business leaders about bringing that production of semiconductors back into the US and the progress they hope to make with the CHIPS Act. But as always, looking for a little bit of optimism, up 1.4% on the NASDAQ Golden Dragon China Index, a local media report out of China that says Beijing regulators are looking at scenarios and data-driven approaches in ways to avoid the delisting of US-listed shares of Chinese tech companies. That's sending the US-listed shares of Chinese tech companies higher overall, and yields creeping a little bit higher, up 4 basis points, back to 2.8% on the 10-year. This is a big weekend. I hope you're ready for it, because there is a lot coming our way. Let's just take a quick look at the calendar, and this is what we're bracing for. Luckily, Monday we get a reprieve, but Tuesday, Wednesday, Thursday, these are the biggest names in global technology. They're coming at us with their earnings, but also their outlook. And of course, we're very focused as well with the Fed meeting this week. Speaking of earnings, after hours, some big names reporting. NXP Semiconductor actually had been higher earlier in the post-market session, but now down 1.6%. Strong outlook for the third quarter in sales, strong demand across its different customer bases, including automotive and database. And then the big bombshell drops. Bring up the next board, Mr. Director, and take a look at Walmart. Down significantly in after hours, cutting its profit outlook for the second half of this year, citing higher inflation and fuel costs, the feeling that consumers will stay away from general merchandising, the fact that it will have to heavily discount in order to shift those inventories. You see we're down 9% in after hours, and this is going to be a big story this week in a key week. Obviously, and we're expecting Amazon as well. Right. For more on Walmart, Ed, thank you. I want to bring in our Bloomberg Consumer Team leader, John Edwards. John, what's your take on these results?
Well, yeah, it's obviously to some extent a surprise, given that Walmart had expressed confidence previously in how it would handle, bringing its inventories down. It was something of a contrast with Target, which had moved aggressively to start, cutting prices more quickly to really, slash those inventories, which have built up at a lot of retailers. Walmart had said that it would sort of let them ease down over the next couple of quarters, but I think what they're seeing is that consumers are even more hit by the high inflation than they had expected at Walmart. And so they are also having to move more aggressively than they had hoped, and thus cut prices deeper than they had hoped to, and thus cut into margins.
This from Walmart CEO Doug McMillon. He says the increasing levels of food and fuel inflation are affecting how customers spend. Yep. We're now anticipating more pressure on general merchandise in the back half. I mean, this isn't going to assuage any fears about a recession, is it? I mean, isn't this going to have potentially a big impact on markets across the board?
Yeah, no, I think people are going to be pretty concerned by this because, again, Walmart, had been, out there speaking, pretty brashly about, how it was going to be able to handle this situation without taking any drastic steps. And but what as Macmillan was saying there, what they're seeing is that the shift in consumer behavior, which is part of what led to the inventory buildup in the first place, as people started going out more and shifting away from the sort of spending on house and home that they'd been doing in the past. Now a further shift is happening as people realize, these food prices and fuel prices are really hurting them, and so they're shifting away from big ticket items, continuing to spend on food and things that they have to buy, but the margins are lower on those.
Yes, indeed. Well, the pressure is on. John, I really appreciate you sharing some extra context there. I'm going to let you get back to covering those Walmart results. John Edwards, who leads our U.S. consumer tech team at Bloomberg, thank you. Walmart's results not going to help quell any anxiety among tech investors as we await more earnings this week. We're expecting results from Apple, Alphabet, Amazon, Meta, all of which could give more of an indication about just how large a recession looms. Meantime, the market turmoil has sealed the IPO window almost completely shut. At this rate, 2022 will be one of the quietest years for public offerings in recent memory. For more on this, I want to bring in Phil Hazlitt, founder and chief strategy officer at Equities and Securities. So, Phil, I assume this Walmart news not going to help. The IPO window just going to stay even more tightly shut, right?
I think that's absolutely right. This is kind of just another month of more kind of hits to the IPO market and its prospects. Walmart maybe think like a different company compared to technology companies where it's selling milk and staples, but that's still going to feed through to other companies as well. I think the real eye is going to be on some of these tech stocks, and as they report later through the week, I'm sure a lot of bankers and companies that were hoping to tap the markets are waiting with bated breath.
So is the IPO window shut across the board for all kinds of companies? Or, for example, with this Walmart news, does it more affect companies that are focused on e-commerce? Or, is this something happening more broadly?
Yeah, I think that's totally right. We define so many different companies as being in technology. So I think any company that's related to consumer spending, maybe it's coming up with solutions for aviation or groceries, are going to be severely impacted. But on the other hand, you've got a lot of companies that are actually selling direct to enterprises, right? You've got traditional software companies. They'll feel less impact from the Walmart news, but they're going to keep a really close eye on some of the bigger tech names as they report. However, it's kind of a perfect storm where we've got still continuing uncertainty about inflation. You've got really tough earnings updates and guidance given from companies like Walmart and even Snap last week. And you've also got a historically really slow part of the year for IPOs as well. So that kind of all comes together, and you're probably not seeing anything go out the door until Q4.
KKR told the information that IPOs are a year away. How far away do you think they are?
I think that's about right. I think you've got companies that are preparing everything if the economy does turn around a little bit more quickly. You've got finance teams at each of these pre-IPO companies. We speak to them a lot, and they're gearing up to be ready when that window kind of comes available. Maybe there's an opportunity in Q4 for the strongest, most marquee names, the companies that everyone's super familiar with. But other than that, I tend to agree it's probably not going to be until 2023.
The closed IPO window is creating some tension between employees and employers. You've got all of these employees working at these startups who thought maybe they were going to get an exit and soon. That's not happening. What are you seeing happening below the surface?
Sure. So at EquityZen, we have a really good lens into kind of the feelings and the sentiment of employees that hold these shares. And a lot of the conversations that those employees had with their employer last year was that everything's great. We're raising a lot of money. We're going to be able to go public soon and get liquidity. And that's certainly not the case. And it's actually being kind of exacerbated by the fact that there's been some recent news coming out from some companies where insiders, mainly executives or founders, actually took a lot of chips off the table in 2021 in better times, but didn't make that available to employees. And to me, that's kind of serving as a bit of fuel on the fire for what I imagine will be probably an uprising is a bit extreme, but I think a big movement from employees to ask their employers for more opportunities for liquidity, since it's so important, in this current economy.
Right. There's the company Data Robot. The CEO just reportedly resigned there in part due to share sales that executives were allowed to do that longtime lower level employees were not allowed to do. What are the ripple effects do you see happening here? I mean, do you think employees will start walking out looking for other jobs, or do they not are there not a lot of choices right now because the market is so tight and you've got tech hiring freezes and layoffs happening across the board?
Well, if you ask any recruiter at a venture-backed company if it's become easier to hire engineers, it has not been. So I think that the job market for those types of folks is still really, really hot. And so I think there will be some voting with their feet. The data robot situation in particular was really bad in the sense that these were executives that only joined the company 2 years ago or so. At Equity's end, we see founders that take chips off the table after they've put their blood, sweat, and tears and built the business for the last 8, 9, 10, 11 years. And I think that's actually pretty well received by employees, and it seems very justified. But when you see some senior execs that haven't been around very long, that's what really frustrates people. So I think founders and CEOs really have a choice. You can be reactive and hope that employees stick around, or you can be proactive and start talking about liquidity, because it is a valve that companies can use to retain their best employees without having to dig into more money out of their balance sheets that are obviously getting hurt right now in the current economy. So I think it's kind of a win-win for everyone.
All right. Well, it's good to hear about some win-wins in a situation where it sounds like there's a lot of losing happening. Equities and Securities founder and Chief Strategy Officer Phil Hazlitt, always good to have your context here on the show. Thanks. Coming up, iPhones for sale, but only in China. We will explain why next. This is Bloomberg. Well, in an unusual move, Apple is offering a discount for a slew of products, but only in China. iPhones, Apple Watches, and AirPods will be on sale in China for 4 days. As the company prepares to roll out the next generation of Apple devices, the discounts come as China's economy struggles under the weight of multiple COVID lockdowns. Our Mark Gurman, of course, covers all things Apple. So this is fairly rare, isn't it, Mark?
This is incredibly rare, right? I mean, right now in the United States, Apple's gearing up for a tax holiday, right? So in a handful of states, you'll be able to buy select Apple products without paying tax. You have Singles Day in China, which is a popular shopping day. You have Cyber Monday and Black Friday in the US, right? You have education discounts, but a one-off rare shopping holiday for a few days in China, this is not something I've ever seen before. Now, here's something to point out. On Thursday, that's Apple earnings day. On Friday is when this sale kicks off. As you mentioned, there have been economic issues. There have been sales slowdowns. There have been economic concerns across China over the last several months. Perhaps this might be timed in response to the day after earnings because maybe the China results, and of course this is just speculation, aren't going to be as hot as maybe some people have expected. And this is a quick and easy way to prepare investors, right, and analysts to show we have a quick solution here, and we think a sale, nearly $100 in savings on some items, right, on the high-end iPhones in particular, those 4 days could boost sales immediately into the fourth quarter.
So we're obviously looking ahead to earnings in the next few days. We'll learn more there. Are you saying this is potentially a bad sign?
I mean, potentially a bad sign, right? I mean, if things were all perfect in terms of sales right now in China, I don't know if Apple would be doing a random sale like this, right? Their sales are usually tied to a specific holiday or a specific event. There's none going on in China at the end of this week that I could particularly think of. So there's a reason that you really want to drum up excitement in sales over these products right now with these discounts. I don't really see this as a reason to clear inventory, right? I don't think that's necessary. The new iPhones aren't going to go on sale for about 3 months now, so they still need, right, a quarter of a year worth of inventory. Many of the products that are going on sale for this 4-day special, those products are going to remain on sale even after the iPhone 14 and the other new products come out, right? The Apple Watches that they're handling with this discount, the iPhone SE, the iPhone 13, the third generation AirPods, those are all going to be on sale into next year anyways. So I don't think this is clearly clearing inventory. They clearly want to drum up sales somehow, some way with this.
Interesting. All right. We'll keep watching. Of course, we're going to be watching your coverage of earnings later this week, and then we'll be watching to see how this sales promotion rolls out. Mark Gurman, thank you. Coming up, Meta continues to add TikTok-like features to its platforms. Is it working? We'll talk to a former Instagram exec next. This is Bloomberg. Well, just call it the latest episode of Keeping Up with TikTok. Meta is now introducing music revenue sharing on Facebook, which will help creators make money from videos that use licensed music. It might also help Facebook compete with TikTok, or will it? Last week, Facebook also changed its timeline algorithm to look more like TikTok. Liz Pearl is a former head of teen community at Instagram and now consults with big tech companies about the creator economy. Kurt Wagner covers social media for us. And Kurt, I just realized when I read that pun that it ties into Kylie Jenner, who just tweeted or posted on Instagram saying, "Stop making Instagram look like TikTok."
That's right. I actually thought you did that on purpose because we were just talking about it. That was incredible
Totally
timing.
unplanned.
That's right. Kylie Jenner, obviously huge on Instagram. Said, stop trying to make Instagram look like TikTok. We just want to see, you know, our friends and family on this app. This is not what this is for. You might remember a few years ago, I believe it was her, she tweeted about Snap and the redesign at Snap, sent the stock down.
Plummeting.
That's right. And so she has good timing. I think Facebook's earnings are in 2 days. So, you know, she's getting her voice out early.
So, Liz, are all of these efforts by Meta to make Facebook and Instagram more like TikTok, is this the right direction, or should they be working to differentiate Instagram and Facebook from TikTok?
Well, I always say that TikTok is the best place for views and the worst place to build a sustained reoccurring audience, right? And Instagram's identity for so long was as the place for building a dedicated audience that wasn't as susceptible to virality or outside forces in general, right? You can't even share links on the platform. So if Reels really does go all in for like a TikTok For You page, like Feed For You is what we call the TikTok feed, which essentially devalues followers. I think that's a pretty big departure from them identity-wise, and I'm really curious to see how that plays out.
So I wonder, Kurt, you know, on that note, should Instagram be leaning into more of the things that make Instagram great rather than just, some say, copy TikTok?
Right. Well, on the one hand, that's a way to kind of keep your place in this world, right? If everyone's rushing towards the same spot, you know, they're kind of giving that up. On the other hand, clearly what they're seeing behind the scenes is motivating this, right? And so if you're Instagram, and Liz would know this, you know, better than I would, but if you're Instagram and you're seeing people maybe leave or spend more time somewhere else, the reality is Facebook is always just chasing that attention, right? And so that's what's going to happen. But you're right, maybe long term, keeping that foothold kind of with friends and family would be a smarter play. Given
that you worked at Instagram for so many years, Liz, is that what's happening internally? Are they watching TikTok and just thinking about how to keep up?
Well, I can't speak to what's happening internally there right now, but it reminds me a bit of Stories launch, to be honest, which I was there for. I mean, you know, there was a lot of dialogue of people thinking it wasn't going to be successful, and actually there was a huge market for people who that format was perfect for, but were not necessarily using Snapchat. And I do think we think of TikTok as pretty ubiquitous, but there is a market for people who love that format and both creating and consuming content in that format who might not necessarily get on TikTok. So there is an opportunity area there, of course.
What is the value proposition to creators at this point? You know, if you're a creator, where do you decide to invest your time, given the options right now?
Really depends on what your goal is and what type of content you want to create. But I do think for younger people in general, like I do believe in adapting to what young people want. And, you know, mobile video tools, really good mobile video editing tools. I think it's TikTok's very underrated for how good their easy and good their mobile video editing tools were when they launched. Has forced us all, like every platform, to sort of up their game there, and that's a net good, right? Giving young people the tools that they want and already are using to be able to communicate across more platforms, a good thing. And I think competition's a really good thing among social platforms. It might be an unpopular opinion, but it's great for TikTok to have some competition.
And Kurt, there's obviously a competition for eyeballs and attention, but there's competition for creators. You know, talk to us about how that competition is playing out. I mean, part of what has made TikTok so successful is the music, which is what these new changes at Meta are geared towards.
Right, and because that drives culture, right? Those are the types of songs that people want to see, to pair that with your video. But also, I mean, let's be real, this all also comes down to business, right? If you're a creator, where can you not only get the most views, but can you monetize those views? And that's why YouTube has historically been such a great place for creators, better than Facebook for video because it's easier to make money there, right? We saw Vine. Vine was great. Vine was TikTok before it was TikTok.
Yeah.
There wasn't a great way for any creators to make money on Vine, and they went to other places, right? And so I really think it's going to come down to which platform can give people a chance to make a living off
There's
of
a
this.
whole graveyard of these social media platforms.
There are.
Liz, I wonder what you make of Kylie Jenner's comments. I mean, Kurt brought up, the Kylie curse. Snap, some people think Snap has never been the same since what Kylie Jenner said about Snap. But what do you think about this idea that at least one celebrity power user doesn't want Instagram to look more like TikTok and maybe wants Instagram to be Instagram?
I mean, I think anybody whose business, which hers largely is, Instagram in a way that it wasn't even the same on TikTok, is predicated on having this audience that you develop and having followers be really, really key in that main feed, is going to be resistant to this and resistant to change in general, right? Us older generations, we are. This is a play that's really catering. It seems like it's catering to an audience that prefers a different format. Something that I think we were talking about music rights and sound, like something that also another very underrated thing about TikTok when it launched actually is Musical.ly, right? Which was the first incarnation of TikTok that was really popular with tweens, was how central sound was to the platform, right? Like music, lip syncing, the very first foundational communities on that platform were dancers. And there's no surprise there that was the case. Their biggest stars came out of dancing. And when video became important on Facebook and Instagram, sound was a feature, right? Not the center of their video tools. So I think that's been a defining difference between TikTok and these other platforms. And it's going to be interesting to see hopefully this music rights platform will be expanded to Reels soon and close that gap a little.
Quickly, Kurt, what has Facebook said in response to the accusations that it's copying rather than developing its own?
It's not shy. It's not shy about this. I spoke to them when they did the newsfeed changes last week, and I said, people are going to identify that you're copying TikTok, and they were kind of like, these are good ideas, right? Same thing they said when stories came out. They said simply, this is a good idea.
Right. So maybe it's not just who can do it, but who can do it best. We shall see. Okay, Kurt Wagner for Bloomberg. Thank you, Liz Pearl, former head of teen community at Instagram. Really interesting to have your insider perspective today. Thank you for joining us. All right, coming up, getting your pediatrician on the line in just 15 minutes. Oh, and also you can text them. That's what the health startup Summer Health is trying to do. More on how next. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. Tesla shares dropped to start the week after the company's quarterly regulatory filing detailed updated capital spending plans, a new SEC subpoena, and more on its Bitcoin investments. Who else has more on this story but our own Ed Ludlow with the latest. Ed, what do we know?
Yeah, I like these 10 Qs because you get the nitty-gritty, the detail of what was not discussed in the earnings call. You see Tesla down 1.4%. Interesting because it snapped a really hot run. If you look at the stock over the last 9 days, it had risen for 8 straight days, best run since March, and then suddenly dropped off to reflect the session on Monday because there was a lot of information in there. In fact, let's bring up some of the key details. CapEx is going to be between $6 to $8 billion in each of the next 2 years. That's a slight revision upwards from $5 to $7 billion. Remember, Elon Musk called Tesla's factories around the world money furnaces, burning money in order to ramp up production. But then you also get the disclosures, right? New SEC subpoena relating to that original 2018 arrangement between Elon Musk and the SEC about Twitter sitters. Basically, the SEC wants more information on what the company's doing to hold him to that original deal. And then there's the impairment on Bitcoin, right? Bitcoin was kind of the one of the mainstays of Tesla's balance sheet over the first half of this year, but it's had a really rough start to the year. If we look at the year-to-date performance of Bitcoin, for example, so Tesla registers $175 million impairment loss, but they also sold Bitcoin in that period, right? In order, what they say, to preserve cash on the balance sheet for what could be some fallout on an ongoing basis from the Shanghai plant shutdowns.
Meantime, Ed, Elon Musk in the headlines again for some non-Tesla news that he according to the Wall Street Journal, had an affair with Sergey Brin's wife. Sergey Brin, of course, is the co-founder of Google. The Journal reporting that Brin ended his investments in Musk's companies as a result of this. We know that he filed for divorce earlier this year. Elon Musk denying this.
Yeah.
What do we know?
Yeah, so the Wall Street Journal reported that this affair took place with Nicole Shanahan in December of last year, that the relationship with Brin and Musk had broken down. They cited anonymous sources, and as you saw on your screen just then, maybe we can bring the pictures back up, Musk tweeted a response to somebody who had tweeted the article, calling it inaccurate, for want of a better expression. I won't use the terms that he put on the screen. But he also did a tweet later during the day saying it was in response to a photo that had been tweeted of Elon Musk and Sergey Brin. And in that tweet, Musk claimed that they had been at a party together just 24 hours previous. So not only did he deny that the affair took place, but he also kind of denied the idea that they had fallen out and that they'd been partying together as recently as this past weekend. So another Elon Musk story with very little to do with the companies that he leads.
All right, and one we will continue to follow. Ed, thank you. Well, I want to turn now to the booming digital health landscape with Summer Health, a pediatric telehealth startup that's aiming to make responses to very common medical questions more accessible through a telehealth platform. The idea seems to be resonating with investors. The startup just raised a seed round led by Sequoia and Lux Capital. Ellen De Silva, CEO and co-founder of Summer Health, joins us now. So Ellen, talk to us about the idea here, the driving premise of Summer Health.
Yeah, thanks for having me, Emily. The idea behind Summer Health is a very simple one. We believe that all Americans should have a phone number they can text and get an answer staffed by a doctor within 15 minutes for any of their medical needs. This started out of my own needs as a mother. So we're very excited to launch Summer Health today.
And you're focusing on pediatric care. Why is that? I mean, the idea that I could just reach my pediatrician in minutes is totally novel and kind of amazing, but it also seems like a moonshot.
Yeah, I mean, it sounds like you as a mother may have also experienced this. We're starting in pediatrics for many reasons. Two of the primary reasons are that parents are thirsty to get more medical attention for their children. There is no shortage of parenting questions that come up around health and wellness that parents wish they could ask a pediatrician, but because pediatricians' offices tend to be overworked and sometimes, unfortunately, understaffed, they have nowhere to turn. The second reason is we want to give more access and resources to pediatricians who want to work more. We have learned through starting Summer Health that 1 in 5 medical professionals is planning to leave the industry in the next 2 years, according to the American Medical Association. And anecdotally, in pediatrics, it's far worse. And so we know that pediatricians are looking for alternate ways to practice medicine. We believe that Summer Health is a great way for them to do so.
Why is that providers are leaving and that it's worse among pediatricians?
COVID was tough for everyone, most notably physicians. Physicians have been overworked, understaffed, put through the ringer because of COVID. They also have not necessarily benefited from the ability to work from home the way a lot of other professionals have been able to do. And so many of them are now turning to professions that would allow them to work from home. And in fact, Summer Health, you don't even necessarily need to be face-to-face with a doctor. Your provider can be at her child's soccer game. In particular with pediatrics, pediatricians tend to be disproportionately women who, as we know, have been affected by COVID and lack of childcare resources. 25% of them are part-time and so look to fill the rest of their time with other pediatric work. And we believe that Summer Health is the best platform for them to do so.
Amazon acquired One Medical last week. There's a lot of stuff going on in the telehealth profession. What do you make of that move?
We've been following the news very closely, and we believe it's a boon to the telehealth industry. When a large, very credible player like Amazon comes into the space, it's very legitimizing for the telehealth industry. So we view it as positive, not only for patients, but also for the industry as a whole.
So, there are a lot of patients who are potentially concerned about Amazon owning this company, concerns about how our data, for example, is going to be used. I mean, how can we be sure this is definitely moving the industry in the right direction?
Yeah, again, we think about this a lot. There's such a thirst for more medical care. Our health system today is mostly reactive. It's still mostly done in person, and it's not necessarily servicing the broader needs of patients. But what we learned through COVID is that 88% of Americans have accessed some form of telehealth in the last 2 years. And 77% of clinicians have expressed that telemedicine can actually drive better outcomes for care. So we know that the industry is poised and ripe for this kind of modality. I'm fairly certain that Amazon will abide by the regulations around PHI and sharing of information. But broadly speaking, when we see larger players coming into the space, I would not be surprised if Google and Apple and some other companies start to play in this category. We see a net positive for patients who can access doctors faster.
Interesting. All right, Ellen De Silva, CEO and co-founder of Summer Health. Really interesting what you are starting, and we'll continue to follow. Meantime, Google has confirmed it fired a software engineer who worked on the company's AI team over his public contention that he had conversations with a bot that had become sentient. Yes, he argued that computers have feelings. Google says Blake Lemoine's comments were wholly unfounded and that he had shared confidential company information to third parties. Lemoine predicted his own termination in an interview with me last month.
I don't think we need to be spending all of our time figuring out whether I'm right about it being a person. We need to start figuring out why Google doesn't care about AI ethics in any kind of meaningful way. Why does it keep firing AI ethicists each time we bring up issues?
You can watch that full interview at Bloomberg.com. It's also on YouTube. Coming up, with the crypto winter taking hold after a massive crypto sell-off prompted by the Celsius debacle, we're going to take a look at the future of crypto security with Ledger next. This is Bloomberg. Time now for our crypto report, with Bitcoin sinking back into the $19,000 to $22,000 trading range, and analysts expecting more swings ahead of another Fed rate hike. Question everyone is wondering, has Bitcoin found its floor yet? Our own crypto contributor, Sonali Basak, has been investigating that very question for us. Sonali, what are we thinking?
So it's interesting, Emily, you did see last week Bitcoin flip up past 23,000, and it has come back down. It has had several days here of muted price pressure, and to your point, it has some catalysts ahead that could make the ride ahead a little bit rocky. But again, that $19,000 to $22,000 range has everyone wondering, is the leverage completely out of the system? See, if you take a look there, yes, we've had that pressure on pricing, but over the last 7 days, you are still seeing Bitcoin trading higher than it was 7 days ago. I also want to show you a quick chart of Ethereum, because even though you're seeing a bigger decline over 24 hours in Ethereum than you are seeing in Bitcoin, also up over the last 7 days, as there is some excitement about Ethereum and around Bitcoin. For Ethereum, of course, there's that merge date on the table now. And does that excitement hold? And does it push the prices back up, even in the face of all these uncertainties, is the big question. And one more time, is that leverage out of the system?
Indeed. All right, well, we're going to explore this a little bit more. Our next guest has his own read on this, and that is Ian Rogers, Chief Experience Officer at Ledger, a platform that provides hardware wallets for securing crypto assets. We're going to get into crypto security in a moment, but first I just want to get your read on the winter, Ian, as it were. I mean, do you think Bitcoin has hit a floor? Is it only up from here, or is what we saw over the last couple of weeks just a head fake?
You know, I don't think any of us know exactly what happens in the short term. I mean, for us, it's a really long-term bet on digital assets overall. I think, you know, from our perspective, you have this new human invention, and it's definitely going to have a massive effect on humanity. So what's the arc of that? What are the ups and downs? You know, very difficult to say. But you know, for me, having lived through, you know, the dot-com bubble, you know, this is like asking, you know, what was it going on at that moment in time when the market had crashed, but the internet was inevitably and unquestionably going to have a massive impact on humanity.
Now, you can talk about Bitcoin all day to that end, but what about everything else? What about the NFT landscape? What about Web3 overall? How are you preparing for what the industry might look like coming out of this crypto winter?
Well, just today at Ledger, we launched Ledger Market. That was 5.5 hours ago, and we've done $3 million in business in the last 5.5 hours. So I think, again, we're going through this once in humanity digitization of everything. And I think if you fast forward 15 to 20 years from now, your passport is a digital document that is issued to your digital wallet, and the way that you prove you are who you say you are is you prove that you are the owner of the wallet containing that document. I mean, that's the scale of what we're talking about here. I think it's very difficult to pick winners and losers, just like in the late 90s or 2001, 2002. It was very difficult to pick winners and losers, but you could bet on the internet long term. And from my perspective, you can bet on digital assets, security, and self-custody as things that are there. These are long term, and if you have a portfolio that's focused on those things, it's likely to return over time.
You're talking about self-custody and storing your own crypto here. What has this moment in the industry taught people about ownership of crypto assets themselves and the difficulties in doing so, especially as you see so many exchanges really show you that they own the crypto that you think you own?
Yeah. It's a great question, because I think, unfortunately, people are, keep equating the bankruptcy of, Celsius and Voyager with, with crypto overall, which is like equating, Bernie Madoff with the stock, with the stock industry overall. I mean, it doesn't make any sense. I think what, unfortunately, it's done the hard way is it's taught people what people in the crypto industry have known for a long time: not your keys, not your coins, and that is, one of the great inventions here is that you can actually hold on to your own assets so that a run on the bank isn't possible. But unfortunately, if you just kind of go, into a system where, you give somebody else your money and you ask them to manage it for you, well, all kinds of things can happen from that moment.
Ian, you're a former Apple Music executive. You worked at Beats, and I'm so curious what the relationship is between what you see as the potential relationship between music and crypto. Are there any lessons that you learned in your former life that you're applying to crypto security?
But definitely, I left college in 1995 to go on tour with the Beastie Boys, and then I was at Beats. I worked with the great, talented team at LVMH the last 5 years. And even though my background is computer science, if I'd learned nothing about marketing with those geniuses, then I'd be pretty stupid. So I think one is just, how do we take a brand like this and bring it into culture, and that's one of the things that we're trying to do. But with respect to music specifically, I mean, music is already 99.9% digital, and I think that the internet brought us this revolution of information, and what we're going through now is a revolution of value. So given that music is on some level information, it's kind of already been set free and digitized. But to the degree that, as you can see, I'm a record collector. Those are collectibles, and those will have kind of different levels of utility. I think what happens over the next year is you get these applications that, in some ways, resemble MySpace. MySpace was early, it was messy, old people didn't understand it at first, but people will use it as a way to showcase their digital belongings, and then those digital belongings will get them access to other parts of the world. Imagine that I buy that Louis Vuitton handbag, it gives me a token. With that token, I can get into Louis Vuitton world, and I'm not waiting on the street in line anymore. This is the kind of thing that this combination of kind of digital and physical is going to bring to us, digital and physical ownership, that is.
So since we've gotten your thoughts on the crypto industry, I'm curious for your thoughts on the evolution of the music industry. Earlier in the show, we were covering Facebook offering new tools to creators who want to make licensed videos with licensed music in them. Obviously, TikTok has totally kind of reinvented this category of social media videos to musical tracks. What do you see as the evolution of music combined with social media?
Well, I mean, I think what I've always said is, when I was at LVMH, it was the same as when I was in the music business, in that we sold culture as a prerequisite to selling product, right? When people are buying music, even when they were buying compact discs, you weren't buying, a compact disc. You were buying, when a teenager was buying an Eminem CD, they were buying, what Eminem means to them, right? And I think it's the same when somebody buys a Dior handbag. Dior means something in culture. Therefore, you purchase the product. So now that we've had this revolution of information with the internet, information is free. And someone in a small town in Indiana where I grew up has the same access to culture that someone in New York or London or Paris or Tokyo does. I think that's what's completely revolutionized, and I think, largely it's moved us kind of away from these mass media sources and into kind of tribes and cliques. We all feel that, coming out of the pandemic, but that of course affects, it affects everything, including music. Music is, it's not just sonic, it's a way of belonging.
That's kind of beautiful. Ian Rogers, appreciate you taking a swing at that with us, Chief Experience Officer at Ledger, along with our very own Shonali Bosick. Thank you. Coming up, San Francisco is becoming kind of a ghost town, some say. We're going to talk about the real-life impacts of the flight from Silicon Valley next. This is Bloomberg. The market downturn has hit the U.S. economy hard, but it's hit San Francisco's economy particularly hard. With local giants like Apple and Google planning to slow hiring and more tech workers working from home permanently, the tech sector that supercharged the Bay Area economy is now leaving a vacuum in Silicon Valley. Bloomberg's Romy Varghese joins us now to discuss. Romy, you've got a big piece out on this now. Why does it seem like San Francisco's been hit harder than other U.S. cities?
Absolutely. San Francisco has been hit really hard. And that's because so much of our economy revolves around tech. And unlike in New York, which is very finance dominated, tech companies here have really embraced remote work policies. So that means you have fewer employees taking transit, fewer employees going to restaurants, fewer employees taking, going shopping and supporting the economy that San Francisco depends on. And meanwhile, you have a lack of international tourists, and international tourism has not rebounded to the levels pre-pandemic. So all in all, that means that the recovery here in San Francisco is trailing that of many major U.S. cities.
And you're seeing more and more companies offer more and more remote work options. So I wonder if we can't depend on tech to revive the city. And if not, what can the city do to revive itself?
The city is making its biggest push yet to revitalize downtown and to give office workers a reason to go downtown. So they are going to emphasize, let's take this vacant commercial space and have festivals and markets. So that employee would think, well, yeah, maybe I will go into the office today because I can do something cool after work. Their hope is to get workers consistently going into the office 3 days a week. That would be a huge help to the local economy.
Is there any hope that the tech scene could come back to the rescue?
I think that they are really working on making the city seem safe and secure, and that's why they have these so-called ambassadors around transit stations and major tourist sites, like cable cars, to make it seem like, no, you can come to the office. It'll be fun. And if they can get tech workers and other people but mostly tech workers, to come 3 days a week, that would be a huge benefit to the city.
You know, it wasn't long ago that I saw a raccoon walking down the sidewalk in the middle of San Francisco at 11 a.m., Romy. 11 a.m. There was a raccoon on the sidewalk.
I believe it. I believe it.
That's what this has come to. All right. Well, great piece by you today. You can catch it at Bloomberg.com on how San Francisco is dealing with this. Bloomberg's Romy Varghese, thank you for joining us. That does it for this edition of Bloomberg Technology. This week, we are all over earnings. Join us tomorrow. We're going to be breaking down Alphabet results along with Microsoft. You don't want to miss that. And of course, check out our podcast, as always, wherever you get your podcasts. I'm Emily Chang in the beautiful city of San Francisco. This is Bloomberg.